Well, hi again, everybody. This is Michael Moskal, Director of Investments at MGO, and welcome to our October 30th Economic and Investment Review. I am here today with John Connery and Parker Kasgan, and today we're going to be discussing some important and pertinent topics that are affecting your investment accounts. So let's head right back into it, and looks like we have the second page up on here. Anyway, let's go from here. All right. So anyway, we are in our 86th year in business, fifth generation actually for MGO. And one thing I thought was interesting, you guys, is that there's a lot of talk about Mag 7 stocks, which everybody knows the names: Amazon, Apple, Meta, Microsoft, Tesla. Who am I missing? Missing someone in there. But there was actually back in the 30s when our company was started and going into the 40s, the original Magnificent Seven stocks, which you see up on the screen, the symbols here, AT&T, General Motors, IBM, Standard Oil, which became many of the oil companies that we know today, by the way, ExxonMobil, Chevron, all came from Standard Oil when they were forced to break up.
Right.
GE, DuPont, and United States Steel Company, U.S. Steel. So those were the big Mag 7 stocks back in the 30s and going into the 40s. And it was just kind of interesting because it seems every generation has their own set of stocks that tend to go on. And then another set of stocks ends up taking over after. All right, market performance through the 27th of October. Parker, you want to go through a couple of these?
Yes, the MGO equity ETF portfolio continues to perform really well, up a little over 22% for the year. We added the gold position going into the year. We increased our international position. I think it was the highest we went international since 2011. So that's played well with the international markets up a little over 26% and gold up a little over 50%. And then we also added the MGO alternative growth portfolio the past month. So that's new to our clients and something some of you are already in. If you're interested, you can always reach out to us and we can talk about it further. But we have some gold positions in there. We have a lot of crypto exposure in there. And we also have some private equity exposure in there as well. So kind of a new idea and concept, a little riskier of a portfolio, but you can see the outsized gains the past 3 years are 30%, 44%, and 27%. So
Yeah, and that portfolio, we launched it, we've had it, and we made it public. We had a lot of interest in people asking us about Bitcoin and different kind of crypto, and of course gold more recently, and some of the other precious metals have become very popular. It's interesting seeing the dichotomy with clients, though, of interest and not interest in this portfolio. And this is a general statement, because there's certainly older people who have an interest in this. But I would say the younger folks tend to be a little more interested in investing in Bitcoin and some of the other cryptocurrencies. And I've had feedback from some older clients that say, I want nothing to do with this. I don't want anything to do with cryptocurrencies. So, but definitely something of now and something of potentially the future because cryptocurrency is not going to be going away, and we'll be seeing that. A couple other comments, by the way, up on the top of the page up here with equity ETF. Parker had mentioned that we have our highest weighting since 2011. And I think the foreign weighting in our portfolios is about 33% now with that equity portfolio, Parker.
yeah,
So we're about a third of our equity is in international stocks. And we were down to, I'm going to say 3%, 2%, going back maybe 3 or 4 years ago. So we have significantly increased that position. There's a number of reasons why we've done that, which we'll talk about shortly. The S&P 500 index, the only thing you got to be careful of, it's a proxy for what the stock market in the US is doing. 40% of it is the technology market at this point in time. And actually the current Magnificent Seven, the ones we mentioned, the Apple and the Amazon and the Microsoft and Meta and Tesla, those kind of stocks, those seven stocks, those make up about 35% of this index. So as long as those stocks are doing well, the S&P is going to do well.
and it's made it really hard for managers to keep up. I think it's only 25% of active managers are beating the S&P 500 this year. So
Yeah, it
Yeah, that's
sounds
really
about
probably
right.
a 10-decade low or something longer like that, then they're beating it. So
What'd you come up with, John?
I think it's probably at least 10 years since it's been that low in terms of the percentage of active managers beating the indexes.
Yeah,
And
fortunately we're one of them. Fortunately we're one of them. We've with our foreign positions in gold and silver and some of the other things we've done in the portfolios, we're outperforming this year. But you're right. It's tough. It's tough when, unless you're just investing in those seven stocks that are driving so much of the performance. I don't think it's quite like it was a couple years ago. But in 2023, going back to 2023, I think it was like 85% of that S&P 500 return was the Mag 7 stocks, just those seven stocks generated most of
yeah,
it. It's not quite that high now, but I think it's still something like 50 or 60%. So it's a
yeah. I
pretty
mean, you've seen it this year. You've seen industrials do well, aerospace done well, financials have done well. Utilities of all industry sectors is up to over 20% given demand for energy, which is driven by these data centers.
Yeah, that's part of the AI trade, right?
Yeah,
So bonds, Bloomberg U.S. government credit bonds are actually having a pretty good year, up nearly almost 8%. And that's with rates dropping, because remember, rates and prices of bonds move inversely in different directions. So if rates are dropping, interest rates are dropping, bond prices are generally going up in value.
right.
And then alternative growth we mentioned already. John, you want to talk about gold a little bit down here?
Sure. Yeah, gold's had its best year since 1979. It's up 52% through yesterday. It's had a little bit of a pullback this month, but that's healthy and normal. And given how it spiked in September, it's coming on the heels of two pretty good years too. It's, up 28% last year and up 13% in 23. And what's driving that? People ask, a lot of it's just foreign governments buying it. They're, looking to diversify away from the U.S. They don't want to be as dependent on the dollar. They're concerned about the debt levels in the U.S., so that's certainly one that's driving it. And one thing about gold is that it's been just an outperformer for us. A lot of other portfolio managers really have no position. It's probably 40% have no position in gold. So we think it could see a catch-up trade in the back half of the next couple of months as you want to try to show some exposure there. Oil's third straight down year. It's been tough with oil. U.S. isn't as dependent on the Middle Eastern countries now, so we're really not held hostage to events over there as we have been in the past. And there's just more supply out there. So it's continued to be kind of a drag for that sector. And Bitcoin, after two really strong years and really a strong decade, has sold off this year, has not done as well this year. It's been pretty flat, I think, since March or so, it seems like. And but this is a market, this is a sector that it can pop pretty quickly. I think Ethereum has done a lot better than Bitcoin this year, and I'm not an expert on these cryptocurrencies, but um, as you know, they're volatile. They've been very good performers longer term over the last 10 years, but this year it's 20% seems like the market doing like 5% because given how well it's done the last couple of years.
Yeah, yeah, it's interesting because we get questions from clients as far as gold is concerned and Bitcoin. One thing about gold, and John, you're right. Definitely foreign central banks and are diversifying away from the U.S. dollar. It's really started with China back in 2017 when they started divesting themselves of U.S. treasuries, and they still own a ton. They still own 500 or 600 million dollars worth of treasuries, but they started divesting themselves from treasuries and buying something else, which was a lot of precious metals and gold. And then other countries now have been doing that, especially since 2022 when Russia invaded Ukraine and we froze Russia's assets here, justifiably so. They invaded a sovereign country. But I think the rest of the world sort of looked at that and said, gosh, if you can just freeze our assets that we have in the US and treasuries and other securities, maybe we should start looking at divesting and investing in something different. So this year, I think I read that foreign central banks are going to buy up to 1,000 metric tons of gold, which they bought a lot
Hmm.
already, which is twice as much as they have ever done in the past. I think 500 metric tons was the most ever before. They're going to buy up to 1,000 this year. So they're buying a lot of gold, which is a part of the reasons why you see gold prices going up. We do see gold going higher. It's about $4,000 an ounce. We do see it going higher over time. We went up pretty quickly, pretty far, pretty quickly. Wouldn't be surprising to see a pullback, but we are favorable on gold.
Yeah.
Bitcoin's one of those
And one
things.
thing about
Go ahead, John.
one other thing about gold is that, it's an inflation hedge. And I was listening to a podcast yesterday. It was a pretty interesting anecdote. They said that Roman soldiers were paid in gold. And I forget what the exact amount what they got, but if you track that out, it's basically like making like $75,000 a year now.
Oh,
So it's yeah, pretty interesting tidbit.
yeah, that is interesting. It is interesting.
Yeah.
Bitcoin's another one and other cryptocurrencies. We do have it in an alternative growth portfolio. We'd like to see how it does in an adverse economic circumstance. It's really not been tested. Really for investment purposes, it's been around for about 10 years. Bitcoin's been around longer, but nobody heard of it before really 10 years ago. So we'd like to see how it does in a downturn economically as well as an adverse investment market situation, bear market in stocks. So
Yeah, I mean, look at the 22 numbers down 70%. So that's the risk
that's
and
that's the
volatility you're talking about.
volatility down 78, up
Yeah.
150. It's had a lot of volatility. All right, a topic of interest, of course, now is the government shutdown that's going on. Nobody seems to really care too much, except for some of the news channels. This is nothing new. We've had quite a few shutdowns in the last couple decades. I think we've had something like 22 shutdowns or something if you go back to the last 30 years. But we're at 30 days now, going on 30 days. I think today actually is the 30th day the government's been shut down. That is it's a five off the record, which was in 2018. Trump won, was 35 days. But it has been sort of non-events. If you look at what it's done in the past here, a lot of the numbers that you see to the right of the charts are all positive numbers. So the stock market itself has not really looked at this as being something super negative. So after 100 days of the shutdown, you see a lot of positive numbers here going back to 1981. After 1 year, some very large positive numbers for a lot of those years. So it's really been a non-event, which is why we haven't really focused much on it because nothing really bad has happened from it. But we'll keep an eye on it.
Yeah. I mean, ultimately, it comes down to earnings. And, so far, third quarter earnings are coming in, probably at a 85% beat rate, which is much higher than the average, which is probably 65 to 70%. So that's what drives the markets ultimately.
Yeah, and the reason for that, of course, is that companies, when public companies, when someone's buying a stock in Apple, they're just buying a little share of ownership in Apple. And if the earnings are going up and for the Apple, if they're making more money over time, that stock price should go up over time, right? So
Right.
it's a pretty simple formula. It doesn't work that way day to day. We know that. Day to day, the markets are
Right.
very emotional and things happen that you wouldn't expect to happen. But over the long term, stock prices are only going to be driven by how much money those companies are making. That's it.
Right.
All right, Fed rates. The Fed just yesterday cut a quarter point again. September they did the same thing. The question really is how much farther are they going to go in cutting rates, and really why are they cutting? Because some things would say that they shouldn't be cutting. I'll make one comment, then I'm gonna turn it over to you guys. We have this chart over the picture over here with President Trump and Jay Powell, the Fed chair, the guy who's in charge of the Federal Reserve. Back in August, the administration was threatening to launch an investigation through the Justice Department, with the Fed. The Fed is renovating their buildings, and it's not cheap because they've not been renovated, I think, since like the I'm going to say 40s, maybe.
Right.
They haven't done much renovation with the Fed building in Washington, but they're doing it now, and it's not cheap. It's running into the billions of dollars because they're redoing the whole building. So the administration had threatened a major lawsuit because they thought there was cost overruns going on, and it was sort of implied you need to play ball with us and cut rates. And it's not just the presidential administration, by the way. Elizabeth Warren in Congress, AOC in Congress, they were all wanting to push to have the Federal Reserve cut rates. Why is that? Why do we want lower rates? Why do they want lower rates, the politicians?
Well, number one, the interest on the debt is significant. And I think Parker mentioned earlier that it was 13% of our expenditures, something like that. And also think, they're trying to get the housing market going. I mean, it's been in a really tough sledding for housing and housing stocks and housing industry the last 3 or 4 years because people are sitting on, 2, 3% mortgages and they got to get a 6%, 7% mortgage. So they're trying to unlock the housing market is, I think, another thing that the government wants to try to facilitate.
Yeah, I think a
And then,
1% decrease in rates frees up $380 billion in the budget. So you can just imagine over, a
Wow.
decade, you're talking about $4 trillion.
Say that again, Parker, if you would. That's a big number.
Yeah, 1% decrease in rates frees up about $380 billion a year in the federal budget. So they're
Wow.
expecting interest expense the next decade to be $13.8 trillion dollars in just interest payments on the debt. So
Yeah, so that it's part of the political motivation here is that we're paying I think over $1 trillion a year in interest costs on our debt that we have. And the
yeah.
debt in this country is about $36 trillion, and we're paying about $1 trillion a year right now in debt service, debt costs. So yeah, if you're a politician, that doesn't look very good. You'd like to have that number down more, and the way to get it down is by cutting interest rates. So that's one of the things.
Yeah.
And John, you mentioned about housing. Yeah, I mean, the lower the rates are, the more people are going to borrow money to buy houses and buy cars, and the more businesses are going to borrow money to try and expand their business, and it juices up the economy. And every
Right.
politician's looking out at the next election, which is next year, and saying, "Hey, we want the economy to be looking good when people go to the voting booth." So we get the political motivation of it. The political motivation of it. I think the Fed's saying a couple different things. They're not really saying it's political motivation, which they're not going to say. What's the Fed saying?
Well, I mean, they've got a dual mandate, right? They're supposed to keep inflation low. Their target's 2%, and they've got to be they want the economy at full employment. So, inflation's kind of been stubborn. I think it's going to take a long time to get 2%. In fact, the Fed has this thing called a dot plot where they project out where interest rates are, and they don't see them getting to 2% until 2028. So, 3 years out. Um, so inflation is, right now it's high twos, 3%, which seems manageable. But we've seen job numbers go down in terms of the employment numbers have been weak the last couple of months, and so the Fed kind of threw cold water on having a December rate cut, which pretty much been priced in at 100% by the market. Now I saw this morning it's only 73%, but that's what caused the market to sell off a little bit yesterday. And one of the things he's citing is that they don't have enough data. They're concerned about the job market, so maybe there won't be another cut in December. But we'll see how it plays out in November, and they get this shutdown settled hopefully soon. There'll be much more data for them to look at, and if the employment remains weak, they probably will cut again.
Yeah, and I would say also if they get political pressure again, I mean, because look, the Fed's in Washington. They're supposed to be independent as an organization, but they're right there in Washington, and they've always been. I mean, going back, the Fed was started in 1913. It wasn't quite then where had the political pressure, but starting really in the 30s, 40s. So going back almost 100 years ago, it seems like every administration and Congress is putting pressure on the Fed to keep cutting rates. They want rates lower. So we'll see what
Yep.
happens with in the political environment too. All right, tariffs, it's still out there, right? Tariffs are still a big thing. Every day it's in the news. And remember, tariffs are just a tax on goods coming into this country. That's all. That's what a tariff is. So, and the question is, are we making progress? Who's actually paying for the tariffs? When they come in, because if you import, something into this country, you import some kind of metal or material, someone's got to pay for that increased cost if we're slapping a tariff on it, a tax on it. So, Parker, you want to talk about the taco trade? Because that's kind of seems like it's been actually a real thing.
Yeah, so Trump, he kind of will say he's going to do one thing and then he flips around and does another thing. He kind of, if the market reacts negatively, he's going to pull back a statement. And so it's kind of, he definitely pays attention to the market and kind of decides on what he's going to say about that. And he'll
Yeah,
throw out a
yeah.
tweet and the market will go up, throw out another tweet and the market will go down. So,
Yeah, and remember what taco stands for, right? It's I guess Trump always chickens out.
yeah.
So yeah, it does seem like there is something to that. And I think 3 times now since April, since the introduction of the first tariffs, that if the market reacts negatively to certain things, that the president does tend to kind of back off and reverse his position a little bit. So I think the markets have sort of gotten used to sort of treating it that way. That if something comes out from the presidential administration, whether it's Donald Trump or Scott Bessent or one of the other, administration officials, if they talk something tough and the markets don't like it, and the stock market goes down a bit, they kind of back off their position a little bit. So it seems like they do. And again, it wasn't meant to be derogatory. I don't think it was just sort of a description to say how they're reacting to certain market situations, the taco trade.
Yeah,
Yeah.
I
And
think
I
Trump also
just earlier,
uses these threats of tariffs as ways to leverage the U.S.'s power. and get concessions from those other countries and get them commitments from them to buy Boeing jets or have some factories built over here. And he has, I don't know what the number is, but I know he's gotten a lot of commitments from a number of countries throughout the globe, probably over $1 trillion altogether.
Yeah, and it's
Well, this
again,
morning that he lowered the tariff on China by 10% and freed up the rare earth mineral deal and for the next year. So kind of use that as a tactic to negotiate again.
Yeah.
yeah, and
Buying soybeans.
tariffs are nothing new. The first tariff in this country, and we've mentioned this before in videos and print when we send things out by print, is 1789. So tariffs have been around for a long time.
Yeah,
And, politicians throughout all those years have used the tariffs for negotiating tools with different countries. And so what's going on is nothing necessarily new. I would say in the volume that is being used is something that's more progressive, certainly than we've seen in a while. Again, it's not something new, but something we haven't seen in maybe 3 or 4 administrations. So there's pros and cons. I think our revenue, Parker, you had mentioned a number that we increased with tariffs this year with revenue.
Yeah, we're up to $195 billion in this year in tariffs, and it's triple what we saw last year.
Yeah, so we've tripled the revenue. Now, again, who's paying for that is a different issue because someone's paying for it. It's probably a combination of foreign countries, our companies here, and us as consumers. But
yeah,
the fact is that we have increased our revenue stream, which again they're using or the intention is to use to try and get the debt down. Now we'll see if that actually comes to true. But we have certainly increased the revenue here. That's a positive. Negatives are you do have some dissension going on with Canada, Mexico, China. When you start threatening, we're going to tax your goods coming in, you just create some dissension that going on there.
sure.
All right, so for our outlook, what do we see going on? It kind of ties into what we've been talking about today, but I still think, and I think we agree as a company that there are tailwinds for the U.S. stock market going on right now. We mentioned a bunch of them. The economy is still growing. John, you mentioned earnings. Parker, we get revenue coming in with, tariffs coming in. Uh, I would say that you have a very pro stock market administration that's in office right now. The Trump administration seems to talk a lot about stocks, which the Trump one did too. They tweeted out a
Right.
lot about, hey, the stock market's hitting new highs. We're doing that. That's a positive for the stock market for the short term. So what do you guys think about the government in quote unquote investing money into U.S. corporations like they did with Intel? And there's been 4 other companies now they put money into, our taxpayer money into.
Yeah, I mean, if anything, Trump's kind of running the government like a business, right? I mean, he's trying to cut call these deals, and then instead of just giving these companies money as a bailout, he said, "We're going to take a stake in you." So I think it's been done before. I think the government made didn't they have? I think when they bailed out GM back in 08, 09, I think they made some money on that, and I think they may have made some money on TARP, but this is more pronounced with more private company or some more higher profile companies. So um,
Yeah, and
I
John,
guess it's good
John,
and
you go back far enough, and with me, that back in the 1980s, you remember the savings and loan crisis? Okay, that back in those
bad.
days when banks in Texas had overlent and made a lot of bad lending deals, and the savings and loans started going out of business. They started going bankrupt, and the
Yeah.
government actually, U.S. government, came up with the Resolution Trust Corporation and started putting taxpayer money and buying off the assets off those banks, which they made money on because they had to sit. It was a lot of it was real estate. They had to sit on the real estate. It was Texas real estate had busted. So we sat
Yeah.
on real estate, and they actually ended up making money, that Resolution Trust Corporation, which was sort of this taxpayer funded government entity. So
Yeah.
you're right. This has happened before. It just sort of gives me a little bit of queasiness to have the government jumping in and buying equity stakes in public companies.
Yeah, you didn't want them picking winners and like they're gonna be favorable to Intel because they've got a stake in them, right? That's
Yeah, it's
the
that's the
floating around.
risk. That's the risk and the
Yeah.
risk of that happening.
Yeah.
Parker, anything? Any other comments?
I thought it was funny. I was listening to a podcast and I think it was a CNN anchor that was on it, and she was saying how some of these I like the government taking stakes in companies is actually an idea that Bernie Sanders had a while ago, and it's funny that Trump's the one now that's actually executing on that thought. Is that Bernie Sanders and Trump have some stuff in common?
Maybe they talked about it. Who knows? They
Yeah.
went out and had a beer and talked about how do we do this.
Yeah.
Last thing just on this page really is the AI. You know, AI is everywhere. Artificial intelligence is everywhere. In the investment markets, the economy, everybody's starting to experience it in some way, shape, or form. Whether you have an iPhone, you have phone, it's on your phone now, AI. There's all kind of stuff going on. Is it a bubble? Is it overhyped?
I mean, a lot of people are comparing this to period to the 90s. And in fact, I saw a chart the other day that compared the market from the start of when Netscape was launched in November 94, and what the market did over the next, 7 or 8 years, and compared that to the launch of ChatGPT, which is in also November, but in 22. And, between in ensuing 3 year, 2.5, 3 years, the charts almost look similar. So that would imply that we're in like it's like 1997 right now. But there's a lot of talk about, are we in a bubble? But if you look at the multiples on the big tech companies, they're all in the 25 or 30s, which is, not out of the realm of reasonableness given how fast they're growing and what the returns and margins are. Whereas in the late 90s, companies were trading at more than double that. And Cisco topped out about 80 times earnings, and there were a number of companies trading in that range or even a little bit higher. So I mean, there could be a bubble with some of these meme stocks and some of these stocks that don't have any revenue right now. That's something to watch. But I think the main companies are in very solid footing.
Hmm.
Yeah, I'd agree. It seems if we are in a bubble, it's probably the early stages of a bubble. And even if you look at back at the bubble, there was definitely some winners that came out of there that, their stock may have dropped 70% of the time, but they're now some of the biggest companies in the world.
Right.
Yeah, and I would say we read so much and hear so much on the financial news about a bubble that when everyone's talking about a bubble, it's probably not going to be a bubble. So we
Hmm.
probably have to get to a point where people say this is going to go on forever. There is no kind of bubble. This is just going to go on and on and on. And we're not. We're just not there. That's another tailwind pushing the stock market up. As AI is a real thing, and there's a lot of money being spent, and it's probably going to continue for a while that way.
Yeah, and if you look at the Nasdaq, if you look at a chart from like 99 into 2000, they had a huge spike in late 99 into like February 2000. So that was like a huge part of the return. And that's when the bubble burst. But we're not really seeing that right now. It's just kind of been a steady up into the right chart.
Yeah, yeah, I agree. I think we're not quite there yet. All right, well, that can kind of concludes. Any last comments you guys have? Thank you to everybody listening and watching. Any questions that you have, or if you have family, friends that need investment help, just, referrals, just let us know. We certainly can help them. Let your advisor know. Our information's on the page here. But otherwise, thank you again, and we appreciate you being clients, and we will see you again soon.